This is the biggest change in the environment that I've seen probably in my career. Tariffs are an increased cost. Somebody has to pay them. Stocks have delivered an average of 10% a year for the last 100 years, but not when the PE ratio was 19.
What if I told you the golden age of the US stock market is already over? This warning isn't coming from some random market commentator. It's from Howard Marks, the billionaire legendary investor who's built his reputation on making contrarian calls that prove devastatingly accurate. For 100 years, the US stock market has delivered an average return of 10% annually, a return so consistent that it became gospel among investors. But Marks is now warning that future returns could plummet to as little as 1% per year. He's not alone in this prediction. Goldman Sachs is forecasting just 3% annual returns for the next decade. The foundation of Marx's concerns rests on what he calls the biggest change in the environment that I've seen probably in my career, the shift from globalization to deglobalization, specifically through tariffs and trade restrictions. This isn't just another market cycle we're talking about. According to Marx, we've witnessed the end of what he describes as the best economic period in the history of mankind, the 80-year period since World War II. During this golden age, global trade created what economists call a rising tide that lifted all boats. The principle is straightforward.
Welfare is maximized when every country does the things it does best and cheapest, and then sells them to the countries that need them, which do other things and sell them to other people. That's how trade works.
Every country does some things better and worse, and worldwide welfare is maximized when every country does the things it does best and cheapest, and then sells them to the countries that need them. Marx illustrates this with a simple analogy.
The news is that the Italians make the pasta and the Swiss make the watches. But if we stop world trade and the Swiss have to make their own pasta and the Italians have to make their own watches, the world will probably be, well, maybe arguably people in both countries will be a little worse off.
The Italians make the pasta and the Swiss make the watches. But if we stop world trade and the Swiss have to make their own pasta and the Italians have to make their own watches, the world will probably be, maybe arguably, people in both countries will be a little worse off. The concrete benefits of this globalization period are staggering. Marx references a 25-year period where the cost of durable goods in the US declined by 40% in inflation-adjusted terms. This dramatic cost reduction kept inflation suppressed and made goods available cheaply to all Americans. Without global trade providing these benefits, the inflationary pressures that have been held at bay for decades are now poised to resurface. Tariffs are an increased cost somebody has to pay them, Marx explains, and the reality is that consumers typically bear this burden. When tariffs were recently announced, the stock market demonstrated just how seriously investors take this threat, falling nearly 20% from its peak within weeks as concerns about corporate profitability mounted. When people refer to the US stock market, they're typically talking about the S&P 500, the 500 largest publicly traded companies in America. The index fluctuates based on investor expectations of future profitability for these companies. Consider Apple, where nearly 90% of iPhones are manufactured in China. Apple currently maintains 40% gross margins on iPhones, meaning that on a $1,000 iPhone, the company generates $400 in gross profit, while $600 represents the cost of goods sold. If tariffs cause manufacturing costs to increase by 50%, that cost of goods sold jumps from $600 to $900 per phone. Suddenly, Apple's gross profit per iPhone collapses from $400 to just $100. Apple faces a brutal choice: absorb the cost and accept dramatically reduced profits, or pass the increase to consumers. To maintain the same $400 gross profit margin, Apple would need to increase iPhone prices to $1,300, a 30% price increase virtually overnight. This leads to what economists call demand destruction, where sustained high prices force consumers to reduce purchases, delay upgrades, or switch to alternatives entirely. The tariff threat represents just one side of a two-pronged attack on corporate profitability. The second threat comes from the global nature of American businesses. While it's commonly stated that roughly 30% of S&P 500 revenues come from international markets, this figure understates the true exposure. The S&P 500 is a market cap-weighted index, meaning larger companies have greater influence on performance. When adjusted for market cap weightings, the true international exposure approaches 40%. McDonald's provides a perfect example of this vulnerability. With a market cap of $220 billion and ranking number 30 in the S&P 500, McDonald's generates approximately 40% of its sales from international markets. The company's growth strategy depends heavily on global expansion, with plans to open 10,000 new locations over the next few years, a staggering 9,000 of which are planned for international markets. When trade tensions escalate, American brands face potential boycotts and consumer backlash in international markets, directly threatening their growth prospects and revenue streams. This creates a perfect storm. S&P 500 companies face higher costs from tariffs on imported goods while simultaneously confronting reduced international sales from geopolitical tensions. They're getting hit from both directions simultaneously. But deglobalization only tells part of the story. The second major factor crushing future return expectations is valuation levels. When Marx released his memo entitled Bubble Watch in January, he highlighted how current market valuations set the stage for disappointing future returns. The mathematical relationship is straightforward and historically proven.
But going forward,
I want to respond first to your last sentence. Stocks have delivered an average of 10% a year for the last 100 years.
Marx explains,
but not when the PE ratio was 19. And the PE ratio today is probably 19. The average return has been 16. So we can say that when the PE ratio averages 16, the return average is 10. But when the PE ratio is 19, my guess is, if you look at history, if you bought the S&P when the PE ratio was 19, historically you probably made...
The PE ratio today is probably 19. The average return has been... So we can say that when the PE ratio averages 16, the return average is 10. But when the PE ratio is 19, my guess is if you look at history, if you bought the S&P when the PE ratio was 19 historically, you probably made, let's say, 1 to 6% a year or 2 to 7% a year, something like that, but certainly not 10. The principle becomes clear through a simple analogy. Imagine purchasing a pizza shop that generates $100,000 annually in profit for $500,000. You'd earn a solid 20% annual return on your investment. But if social media hype drives pizza shop investments to become trendy, pushing the price to $1 million for the same business generating $100,000 in profit, your annual return drops to 10%. The business fundamentals haven't changed, but your future returns have been cut in half simply because you paid a higher price. Historical data confirms this relationship with mathematical precision. Charts tracking forward PE ratios against subsequent 10-year returns show a clear inverse correlation. As PE ratios increase, future returns decrease. When Marx wrote his Bubble Watch memo, the S&P 500 was trading at a forward PE ratio of 22 times, implying future 10-year annualized returns of somewhere between 0% and 3%. This isn't speculation or opinion, it's mathematical reality. Higher starting valuations mathematically constrain future returns because much of the anticipated growth is already reflected in current prices. No amount of optimism can overcome the mathematics of valuation. Given these dual threats of deglobalization and elevated valuations, Marx recommends a significant shift in investment strategy. He advocates for meaningful portfolio allocation to bonds, stating in a recent memo, "The current level of offered yields implies higher returns from credit than the S&P 500, with returns that are contractual and thus subject to much less variability and uncertainty." The recommendation reflects basic risk-adjusted thinking. When bonds offer higher expected returns than stocks with contractual payments and reduced uncertainty, the rational choice becomes clear. Credit markets are currently offering higher returns than equity markets while providing the security of contractual obligations rather than the uncertainty of corporate earnings growth. The convergence of these three factors, deglobalization pressures, tariff-induced cost increases, and elevated starting valuations, creates an unprecedented challenge for equity investors. This isn't fear-mongering or market timing based on emotion. It's mathematical analysis based on historical precedent and current economic realities. The golden age of 10% annual stock returns appears to be ending, replaced by a new era of significantly lower expectations where 1% to 3% annual returns may become the new normal for equity investors.